morning, everybody. My name is Terry Lammers with Innovative Business Advisors, and I'm here with Harry Hutchinson and Harold Newman at National Bank, and we're going to talk to you today about valuing your business and how to increase value in the business. So a little bit about myself. I've had the opportunity to buy and sell a lot of companies in my time. So I am a CVA, a Certified Valuation Analyst, so we do business valuations. So at Innovative, we basically help people buy and sell companies, do business valuations for whatever purpose, and coach people through increasing the value of their business. So good to have you on, Harry. How are you doing this morning?
I'm doing fine.
Talk a little bit about the bank.
Yes, sir. My name's Harry Hutchinson. I'm the former president of National Bank and actually the president of Country Bank Corp. Inc., the holding company for National Bank, and I'm primarily involved in commercial real estate lending, and happy to be here today.
Harold, you're the chief lending officer. Well, describe what you do.
Yeah, I'm executive vice president of commercial lending. I take care of the underwriting side of things, so I help to look at what the value of the business is so that we can use it as collateral for a loan, so we can help people buy businesses that you're selling.
Very good. 8 locations throughout?
11, Terry.
11
locations spread out all through South Central Illinois.
Very good. Good. Let's go to our slides. So the basics of it is what is your business worth? Well, it's really as simple as it gets. Your business is worth the cash flow that it's spinning off. And typically, when you're valuing a business, we're going to look at the 3 to 5 year trend of the company. So it's really going to make a difference if the company's going along just kicking off a steady cash flow, or has it unfortunately been in a downward trend, or is it doing really good and increasing in value as we go? Another thing that we're talking about, as I mentioned, cash flow. So a lot of people, they want to know, we really focus on net income, and there is a difference between net income and cash flow. And really the difference is the depreciation, amortization, and personal expenses that are on your income statement. All those things are going to get added back into net income to come up with the true cash flow of the company. A lot of people, I find, don't understand what that depreciation really is, a non-cash expense, and it does get added back into the cash flow, right?
Yeah, you add back the depreciation, which is the value of the fixed assets that is being depreciated, and you're getting a tax break on it, so therefore you're not paying taxes on it, so it comes off of your income, so we got to add that back because it's just a paper entry.
Right. I had discussions with a business owner yesterday, small business, and the company was showing a little bit of a net loss, and she was really concerned. She said, we're not having a very good year this year, and I got the financials and added back the depreciation and amortization and called her back and I said, I wouldn't be too disappointed. You're actually having a pretty good year. So depreciation and amortization are non-cash expenses that do get added back to the net income, and the bank recognizes that. The other thing, as we're going to value the business, we really want to take a look at what personal expenses that the company would be paying for that's on your income statement. So things like cell phones for the kids, or maybe an extra car, maybe you got a lake house, or things like that. When we're going to value the business, we're going to add those things back in. The other thing that we're going to add back into cash flow before we value the business is the interest expense from any current loans that you have. And the reason you do that is because we're assuming that the next owner is going to have their own loan structure. Next slide. So where do we get started in this process? It all starts with the financial statements, right?
Absolutely.
So I can't stress enough, if you're going to sell your business, you really need to have strong financial statements. And regrettably, quite often, you get that box of paper and you have to straighten it out for them, don't you?
Yeah, they'll bring it in and it's just a box of papers and not a good financial statement. So it's always best, if you can afford it, to work with an accountant and have them put it together, or use QuickBooks or something that organizes all of your expenses so that you've got your income and expense in one place.
Yeah, it's just really important. So let's talk about financial statements. There's really 3 different types of financial statements. Compiled statements, if you're using a CPA or yourself, is you're bringing the information to your accountant or bookkeeper, and they're putting a financial statement together. So really, the quality of that statement is as good as the information that you give him. So if you're using compiled statements, typically a bank is going to want a tax return to back it up.
That's correct, because compiled is just your information put together.
Right.
We want to see what you're reporting to the federal government.
Right. So reviewed statements, you're going to have a CPA to do reviewed statements, and typically you start getting into reviewed statements when a business has $3 to $5 million worth of credit. Reviewed statements, a CPA is going to look at the financial statements and do, kind of some checks and balances. They're going to look at the accounts receivable and say, does this make sense? Should this company have $1 million worth of accounts receivable? They're going to look at the inventory and say, does it make sense that this company would have a couple $100,000 worth of inventory? And there's a list of things, but mainly at the end of the day, then the CPA is going to sign off on it, saying, I believe these to be true and accurate numbers. Now, when you get into audited statements, much more stringent. They may call a few of your customers and say, do you really have an accounts receivable balance of this? They may check with a couple of your vendors to see, do you really have an accounts payable balance of this? They may go out and physically count some of the inventory, and there's a long list of other things that go along with audited statements. But again, the key to it is, at the end of the day, the CPA is going to sign off on it.
Right. The audited financial statements puts a little bit more pressure on your CPA because they have to give you a non-qualified opinion on that, and which is very important to the external third parties that are looking at those financial statements. From the bank's perspective, we certainly would prefer some kind of accountant-prepared financial statements versus just internally prepared financial statements, because we can place that reliance on a CPA or an outside accountant, and that means that gives us a little bit more validation than it would from internally prepared financial statements from the company itself.
Right. And there's really, a bank's going to look at 3 types of qualified financial instruments, and that's going to be your tax returns. So if you're giving them compiled statements, they're going to want to look at your tax returns. And the reason they want to look at the tax return as a qualified statement is if you lied on your tax return, you can go to jail. If you have reviewed and audited statements, that CPA signing off on those statements, and if it's not right, he could lose his license. So very important. So we talked about adding back different things to the income statement. What we're really doing is normalizing the financial statement. So we're going to go through, add back those things that a new owner wouldn't incur an expense on. And really what we're doing is we're getting into seller's discretionary income. So if you think about seller's discretionary income, that's all the income coming into the company that you have the discretion of spending on whatever you want, whether it's going to a loan payment, your salary, or wherever it's going. So from there, if you're subtracting out your earnings, you're getting to an EBITDA number, and the bank looks at that pretty hard, and that's earnings before interest, taxes, depreciation, and amortization, right?
Right, and that's basically the funds you have available to service your debt with the bank. So we're looking at that to determine that there's sufficient EBITDA to repay the loans.
Yeah. So I don't know how much you see it, but I had a situation this week. I was valuing a bookkeeping business, actually, and the owner was only paying himself $5,000 a year. When you're looking at a financial statement like that, I adjusted on the valuation to say, a fair salary, is going to say be $35,000 a year. So I took another $30,000 out of cash flow from valuing it. And really, I guess on the flip side, you do see situations where an owner's paying him an exorbitant amount, and you may add, so if say he's lucky, he's paying himself $300,000 a year, and maybe a normal wage for that is $100,000 a year, so we would add $200,000 back to the cash flow for valuing it.
Yes, we would handle it that way so that we could go ahead and give a good figure for the repayment ability.
Correct. So what's it worth? There's 3 different ways to value a company, just like there's, like you're valuing real estate. There's a market approach, which is like selling a house. So, if you have a house on one side of the street and it's 3 bedrooms, 1,500 square feet, and it sells for $150,000, well, then the house on the other side of the street, it's got 3 bedrooms, 1,500 square feet, it's probably worth about $150,000. Doesn't really work well for selling a business because most businesses are unique in nature. The asset approach, typically you do a valuation on asset approach if a company is losing money because they're not generating cash flow sufficient enough for a profit. So you just simply look at what assets are there and what's the current price for them. So the most common way that a business is valued is the income approach. And there's really different methods under the income approach. I'm going to give you a simple one today, but we go through a process like we were just talking about, normalizing the financial statements, getting to the true cash flow of the company, and value that cash flow. So the value of that cash flow is if the company has assets that's spinning off cash flow, and the value of that cash flow is greater than the assets, then you have goodwill in the company. And we'll talk about that a little later. But if the cash flow coming from the company doesn't have a value greater than the assets, then you're going to sell the asset approach. So what's a simple way? Like I mentioned, there's several different ways to value a company under the income approach. There's different methods. This method is kind of determining what type of return do I need for me to want to purchase this business. So in my experience, and even when I was buying companies, if I knew I could pay for that company in 3 to 5 years, that was getting into a sweet spot of the number. So let's say your company's spending off $100,000 a year in cash flow. A 3-year return payback would be 33%. So if you divided that cash flow by 0.33, you would have a value on that company of $303,000. And that would be a 3-year payoff. So likewise, $100,000 at 25%, a 4-year return, divide that by 0.25, you end up with 400. And as you can see on the slide, 100,000 at 20% would be 500,000. That 3 to 5 year term falls in a lot where our amortization schedules are for businesses, maybe a little bit more.
It would on businesses that are reliant more on the assets of the business, fixed assets. When you get into the something that has a lot of real estate involved, then you could value it higher. And once again, then you're looking at a value of the real estate.
Correct. And so buildings and real estate really start. It gets interesting when you're, especially when you're valuing the business, and it kind of makes a difference. Do you have to have that real estate to go with the business? Is it a steel mill that we can't just pick it up and move it across the street? So we'll talk about that a little bit more as we go. So once you come up with that number, I go through a series of sanity checks. It's kind of like, well, does this make sense? And one of the big ones, especially if you're selling the company in an acquisition, is it a bankable deal? Can I come to Harold and get a loan to buy this company? If you come up with a value of, let's just say you came up with a value of $500,000 on your business, but there's not enough cash flow there to pay that loan off in a reasonable amount of time, it probably doesn't make sense.
No.
Yeah.
The cash flow is really going to require that. So that's why the rule of thumb for the 3 to 5 years makes a lot of sense.
Yeah.
So we get it paid
there is actually a company called Business Reference Guide, and believe it or not, they publish data that they call rule of thumb data. So that kind of gets us more back towards a market approach. They look at a number of companies that have sold, and will give you an idea if this type of company is selling for 3 times EBITDA or 1 times annual revenue. So that's something to always look at too. So what's you come up with a price. What's a deal killer? The number one deal killer for me out there is people think the business is worth more than what it is, and it's not a bankable deal. So if the company's overpriced, that is my number one obstacle. Another big one that you see is if a company's got assets that's generating a cash flow, if those assets are old or obsolete and that the owner hasn't kept up with them, now you may value the business at $500,000, but I got to go out there and buy another $200,000 or $300,000 worth of equipment to keep getting that same cash flow. That's really going to affect the value of the business.
Very similar on the inventory too.
Yeah.
Which is if the company comes in and wants to buy another company that has inventory, it would behoove them to go in and really inspect the inventory to see how old and obsolete some of the inventory is before they determine what they want to pay for it.
Right. I did a valuation this year, and it was kind of funny. It was on a larger company, And, the first time I met with them, I said, it's got to be a bankable deal or it's not a good number, right? Well, I came up with the valuation. It's like, it wasn't a bankable deal. But they literally had $2 million worth of inventory that $1 million of it was over a year old and another $1 million of it was over 2 years old. So, at the end of the day, I discounted that heavily, but ultimately recommended that they do something with that on the side because it wasn't.
So cost isn't always the determinant, is it?
Yeah. So we're going to talk about this a little bit more in depth a little later, but some value drivers. There is things in selling a company that brings intrinsic value to the company versus just what's coming off the company. Generally, the larger a company is, the bigger the multiple that's going to sell for. Can the company run itself? Is the owner so involved with the company that if he stepped away, things grind to a halt. Recurring income is a big thing. We'll talk about that a little later too. A good example just right off the top is my bookkeeper that I valued his business. He does bookkeeping and tax service. Well, that's good recurring income. Those customers come back year after year after year. So, or is there long-term contracts with the company? Do you have a 5-10 year contract for some type of service? Certain businesses are pretty recession-proof. We were talking earlier, if you look at, just take, for example, coffee. Well, people probably didn't quit drinking coffee while the recession was going on. So businesses like that may not be affected as much. So is there a difference between the company's value and its selling price? That kind of gets into our receivables and inventory. What about my equipment? You run into situations where maybe the equipment that you have, the purchasing and acquiring, the business doesn't need it. I sold a lawn care business, and the guy's got a whole shed full of lawnmowers and sprayers, but he wasn't interested in that. He had his own equipment, so that may make a difference. Inventory and accounts receivable. I did an evaluation this year for a automobile repair shop, and there's actually a method of valuing a business called the transaction method. So when I gave the guy, fair business, been in business for 25 years, I gave him an evaluation of like $800,000, and he was really kind of shocked. Well, the difference was the value in that value, the company was really valued at $250,000, but he had a large amount of cash in the company. He had over $100,000 in accounts receivable. Typically you're going to sell the inventory to the purchaser at cost. So by the time he took in all that cash, at the end of the day, he was going to end up with $800,000. So big difference.
Yeah, a lot of times you see on the receivable side, just to mention, you have to determine how collectible that receivable is. If it's over 90 days, it may not be near as collectible as it is if it's at 30 days.
Right, and that's typically why every business that I've bought, and so far everyone that I've helped people sell, it's just so much simpler if the seller collects his accounts receivable. Because, if you're the buyer, the advantage of buying those receivables is you get quicker cash flow. If you're turning your accounts receivable in 30 days, from the day you buy it, you've got 30 days until you're going to get your first check in the mail. But if you buy the receivables, you have that instant cash flow. But you really do run into that problem of how much of it is collectible and
And we've run into cases where the receivables were out there, we went to collect them for somebody, and they said, well, he didn't do that, or this isn't right, it needs to be fixed, so I need my money back that I've given you, plus we're not paying you for what you got.
Yeah. So I hope you see it can get pretty muddy. Current debt, we're going to have a slide. I'll talk a little bit about that here a little bit later. There it is right there. I was selling a daycare, and we valued the business at $650,000, but typically the owner is going to pay off his debt, and the buyer will have their own debt. Well, in this particular price, by the time he paid off his debt, there's only $52,000 left, and there's still going to be tax consequences on that. So in this deal, he may end up owing money, which is really unfortunate. So got another case study here of a company, just like we was talking about with my auto car repair place. it may be a situation where maybe the company's not worth that much, but they could literally have $500,000 worth of accounts receivable out there, and that's you've already paid taxes on that. And, I guess you can make an argument unless it's cash accounting, but if you're using accrual accounting, you've already paid taxes on income, so that's for the seller, that's money that comes straight to his pocket. So.
Right.
So what makes a deal bankable? This is where you guys get involved, right? Cash flow. No matter how you slice it, there's basically two sides to a loan, right? Cash flow and collateral.
Right. And we definitely look at the cash flow for the repayment ability. The collateral side of things is where we're trying to determine what the bank has to fall back on if the cash flow would fail. Now, the bank doesn't want to take the collateral and sell it because they can't sell it for what it's truly worth. So that's why we have to have excess collateral. So
Yeah, talk about, even on if you're using truck equipment and stuff like that, do you get an equipment appraisal, and then how do you discount that? Because I think that's where a lot of people get surprised is, they value the equipment at, let's just say, $500,000 sounds like a good number. I value it at $500,000. Are you going to use 80% of that, 75, 60?
Well, for a commercial deal, we're looking at about 70% of it. And that's after we verified that the $500,000 is a good value.
Yeah.
So we're going to look at it. We're going to try and get some way to get someone to certify that value and come up with make sure that the value is a good value for us.
Yeah. It's kind of funny, when I owned my own business and I briefly worked for a bank, when I owned the business, it's like, you get an appraisal, get $1 million worth of equipment there, and that evil banker says, well, we're only going to use $750,000 of it. It's like, what? but when you get to the banking side, it is true. One, you're valuing the equipment today, so maybe it's 3 years where you might be getting it back, but then you have to get it back, and then you have to have somebody sell it. So you look at it from that side, it's pretty fair.
And keep in mind that equipment depreciates quite a bit each year.
Yeah.
So what was once $1 million worth of equipment in 3 years might only be worth $400,000.
Yeah. So we got our cash flow, we got our collateral. Probably one of the biggest ratios that you're going to be looking at is a debt service coverage ratio. So that 1.25 that we have up on the screen as a minimum, what that really means is to get to that means you have $1.25 in income for every dollar worth of debt. So what I like to tell people is that's a minimum. What would you rather see, 1.5 to 2?
It would be at least at the 1.5. I'd prefer a 2 to 1. That way they've got a cushion in case something comes up. They have to have some type of major repairs.
Right. So we talked about collateral. Well, one of the hardest things in financing a company is how do you pay for the goodwill? Because you don't like goodwill as collateral, do you?
No, we can't sell goodwill, so
right.
we can't do anything with it.
Yeah. So what do you do to overcome that? Well, SBA loans is a good way to go. SBA 7A program on 504. SBA will guarantee a certain portion of that loan, about 75, 80%.
75% on the 7A program for the most part, and then when you get into, if you go to a 504 where you got real estate involved or major equipment, then they'd be looking at partnering up, and it could be the customer has to have 20% in, could be 10% depending on how good of operation it is and what the collateral truly is.
Right. So the other ways to get around this besides the SBA loan is you could look at how much collateral does the seller have to back up what he's purchasing from the company, if it's an established buyer. Some other ways that get around it sometimes is owner financing. It's a little bit risky for the seller because now he's playing banker.
Right.
And but oftentimes, if the owner wants to get the full value of the company, owner financing, can really be the way to get there.
Well, it's certainly a way to get around the goodwill.
Yeah.
Because the seller financing, they don't need a bank. They're going to finance the whole thing. But
right.
Oftentimes it's a portion of it, and that portion is to make up the difference between the value of the assets that you said or the value of the company value the assets, which, the difference is goodwill.
First company I ever bought was 100% owner financing. It was a little company. We gave the owner 20% down in cash, and made monthly payments to him for 5 years, and it all went well. So sometimes you have to get creative. I've done deals before where a company's been distressed, and I paid them 25% of the gross profit for a year, and that worked out very well. I had a company just recently that it was almost all blue sky. The guy wanted $750,000 for the business, and literally there wasn't $20,000 worth of assets to it. So I had a buyer come to the table that was going to give him the 20% down. He could borrow the 20%, and then he was going to pay the seller 50% of gross sales until he had it paid off. No set payment, just 50% of the sales. So if he ramped sales up, the owner was going to get paid back sooner. If things slowed because all the customers didn't come over to him, then he was still going to pay him back that money, but it might be a little bit more over an extended period of time. So, like I said, when there's a lot of goodwill in a company, it can make things difficult, and sometimes you got to get creative to get around it.
Well, and that also provides, by doing that, I've requested that on several loans for people, because then the owner stays in a position where they have to make sure that the customer succeeds, that our borrower succeeds. So the buyer has to be able to succeed, and if the owner just sells it and walks away, he doesn't care whether or not they succeed. So that's why you do owner financing, for at least part of it.
Definitely got a vested interest.
Yeah, that's right.
It reminds me, it's kind of funny, this company that we bought for the first time, my dad ran up in that area, and the owner would see him at lunch all the time, and quite often he would buy his lunch, but once we got him paid off, he didn't buy his lunch no more. So that kind of goes through the first half of what we was talking about, and I want to talk about something, how to build value in your company. This guy talked about with the $750,000. It's been hard. He didn't take the deal because he didn't want the risk of having the owner financing. And it's been a difficult business to sell because it's just a one-person business, no contracts with the customers. It kicks off tremendous cash flow from that standpoint, but there's things that he could do to make that company a little bit more sellable. And that's where we've teamed up with the Value Builder system, and it's kind of a coaching deal. We take a company through a 12-month course, or faster if they'd like. It's typically set up and do on a 12 months. We send them. We talk about 8 key value drivers that that will increase. It will increase the value of your company and may get you a bigger multiple for your company, but it's also going to make your company more sellable. And if you'd like, I'd like to mention, if you go to our website at www.innovativeba.com, there's a tab on there for Value Builder, and you can take a free Value Builder questionnaire to see what the sellability of your company is right now, and then I'll get that report back, and if you wanted to sit down with me and go through it, we can explain the program. So, but here's some of the things that we talk about, just with the 8 key value drivers of the business. We talked earlier, the financial performance of the business is just so important, from having solid financial statements, being able to produce the financial statements when they're asked for. What's really frustrating is, you get out, it's April 1st, and you ask if you could see the previous year's financial statements, and it's like, well, no, I don't have them ready yet, and they're at the CPA, or if you want, everybody's at a log and file extension on my tax returns. You've got the odd statements, and got to have the tax returns to go with it. If you're wanting to sell your business, get your financial statements up to date and get your tax returns done. It's the first thing that a bank is going to want to have, so be able to produce them. That's one thing that can be frustrating with smaller businesses versus larger businesses. I go to a larger business and ask for 3 years of financial statements, and it's a point and click away, and it's emailed to me, and with smaller companies, that can really be an obstacle. So another key value builder for a business is there growth potential. If I take this company, can I bring it to the next level? And and can scale things up, or typically if you're going to build a sales team, you need to be able to sell a product that you can teach somebody else how to sell it, so you're not the only one that's doing it. Is there value to it, and can you repeat the process? So the Switzerland structure is kind of an interesting term. It's actually based off the country Switzerland, which is a very independent country. They didn't participate in any of the world wars, and didn't join the United Nations until later. So what we're really talking about here is we're looking at three things: customers, employees, and suppliers. And how independent are they from the company? So let's talk about customers. What we're really talking about is customer concentration. So, I'm thinking of a company right now that delivers milk, and they have one customer, and it's the dairy that produces the milk, and they deliver it. Well, if the dairy goes out of business, they're out of business, and I'm sure you look at that on accounts receivable too. It's customer concentration.
Yeah, you look for the concentration to make sure that there's a wide variety of people, because if you tie down to one receivable coming from one large person, if you don't get it from that person, then your receivables are not worth anything.
I actually got bit by that once buying a company. They had one very large customer, and naively I thought, that's no big deal. The customer's been around for a long time. Well, 2 years after I bought the customer, they went out of business, and that put a big hole in things for them. So that is some customer concentration. I think typically the number is what? If you got any customer that's doing over 10% business with you.
Yeah, for the most part, depends on how diverse your business is, but you would generally look at 10%. And like you say, a good company that's been around for a long time might get 15 or 20, but for the most part, you'd be looking at 10.
Yeah. So, if you're selling a company, that would be something. Employees is the same way. We talked about, can the owner step away? But what if the owner's relying on one or two key employees, and if they don't have a non-compete clause or something like that, that's something to talk about. Suppliers can be the same way. If you're selling something that you have to have a license from the company to sell their product, well, if you're going to sell your company, oftentimes that's getting that supplier to give the buyer the license is going to be key. So that's what we're talking about there. So the value teeter-totter, I got two slides to this one. What we're talking about is the amount of capital that it takes to run the company. So, in essence, you're writing two checks. You're writing one check to buy the company, but you got to have some cash here to support the accounts receivable and inventory.
Right.
And so that's where an operating loan may come in. I'm sure you quite often do those.
Yes, we do, and we look at how quickly they can turn those around if we're doing operating, so that they can get that money back into the bank to take care of it.
Yeah. So what we're talking about as far as what can we do to make that increased value of your company? If you can reduce the capital needs of the company, that will make it easier to sell. A lot of times people are struggling just to come up with the purchase price, and then we figure out they need $150,000 or $200,000 just to fund the accounts receivable and inventory. That could be hurt. So we'll take a look at accounts receivable days, inventory days. Can we lower the accounts receivable days, maybe push up the payable days, and leverage out, get rid of old inventory, lower the inventory amount, and make that a little bit more of a palatable deal. Recurring revenue, we talked about this a little bit earlier. Probably we'll have another slide here, but I think a good off-the-cuff contractor, builds a house. Well, he's done. He's got to go find another house to build. If that's use our milk, people are probably going to, they buy that on a regular basis. So, but your basic consumables, we talked about coffee, milk, things like that people are buying on a regular basis. An upfront investment tied with consumables would be, look at your Keurig machine. You had to buy that Keurig machine. Now you got to buy the Keurig packets that go in it. So they kind of got you hooked. So
kind of like that printer toner we always have to buy.
Exactly. So subscriptions, if you can get your business to where somebody's paying you on a regular basis, an upfront investment when combination. Think of software. You buy the software, then you have to pay annually for the license to keep it updated. So if you get into auto renewable subscriptions and
You always want to do that.
yeah, 30 years.
Anytime you have 30 days and you want auto renewable, that way you don't have to worry about it.
So they don't tell you in 30 days that's automatically going to renew. It's automatically income coming into the company. And then obviously, if you have multi-year contracts, that's a good, recurring revenue. So here's just kind of a sample of some good companies that have recurring income. Your insurance companies, property management company, every month you got to pay the rent. So they're collecting. A laundromat, I guess hopefully that's a recession-proof business. I hope people watch it. And ag-related, every year farmers going to farm. I don't think there's been a year that I know of that, just said, well, we're not going to farm this year. So we talked about some bad companies for recurring income. We mentioned contractors. And HVAC and plumbing can kind of go each way. If you're new construction doing HVAC and plumbing, it's the one and done. But if you build your business around a service business, every year the air conditioner's got to be changed, filter's got to be changed. There's
Right.
plumbing issues. I jokingly put my business brokerage on there. Once I sell a company, now I have to go find another business to sell. So, monopoly control, what we're talking about here is the products that you sell. If you can, have something unique about that product that, you can control, hopefully get a little bit better price. So off the top of my mind, if you think of a gas station, they post their price, and if there's one on the other side of the street that's a penny a gallon cheaper, well, they're probably going to go to the other side of the street. So.
Right.
What if you don't know all 3 gas stations in town?
No, that would be a way to do that.
That would be a monopoly.
That would be a monopoly. You're right, and you can charge whatever you
I
want.
see that. I see that in towns, believe it or not. Towns in just this local vicinity. I won't say which ones, but I see gas selling for $2.30 a gallon in one town, and it's $1.98 here.
Yeah.
It's crazy.
Interesting. Number 7, customer satisfaction. This is something you guys probably poll your customers a little bit, but a lot of small businesses, they don't. And I think there's some value to that you can show if you've polled your customers and, you have happy customers. There's a company they use, and, if you're getting rated at an 8 or a 10, it'll help give that buyer a little bit more comfort that they have satisfied customers.
I love reading the internet reviews, particularly when you're going to go stay at travel in a hotel or something. I don't know how much to believe them, but that's a perfect example of what a satisfied customer would do.
Yeah. So our final one here, the hub and spoke. So think of you, the business owner, as the hub. It's good to think of your old wagon wheel, and the spokes are your customers, your suppliers, your employees. If you're the hub of that company, and you can't be taken away from there because all the employees are coming to you, all the customers are coming to you. It's important that if possible, you've got other people in the other employees in the business that can run the company. So I've got a couple of examples here. We recently was working with a trucking company, and there's 2 owners, and each owner literally works 60 hours a week. And, they were there at 6 o'clock in the morning to load the trucks. They each drove a truck, and one did all the maintenance, and the other one did all the dispatching. And, a buyer looking at that, and this really happened. The buyer's looking at it going, if I buy this company, I might need 2 more employees to replace what the current owners are doing in the business. And then if the owners leave, now I need more employees. So that was a bad situation versus another company that I worked with was a petrochemical company, and they had 3 operations managers and a lady in the office that did all the bookkeeping and was in charge of the office. And the owner could step away for a couple weeks and come back and answer a few phone calls, and the company kind of drove itself. That makes a company much more easier to sell, and it increases the value. There's just no doubt about it. So I think that pretty much gets us to the end of our presentation here. Do we have any questions, Lee, off camera? nothing there. So, all right. Well, I hope this adds value to you. If you got any questions about banking or selling your business, please feel free. Our numbers and emails are on the phone. It was a pleasure having you with us today, and have a great day and a good weekend. I'm going deer hunting.